Chapter 11. Bootstrapping and Smart Debt. The safest money you will ever raise is the money a customer pays for value you just created. That sentence is the heart of bootstrapping. You build small, you sell early, you keep promises, and you let revenue fund the next step. Debt can help when it pulls forward a result you already know how to deliver. Debt can hurt when it tries to cover a hole in your unit economics or an offer no one has asked for. This chapter is a calm map of both paths. You will learn how to widen your oxygen with deposits, annual prepay, phased scope, and partner exchanges. You will also learn the rules that make borrowing safer for a small team. By the end, you will know when to say yes to a loan, when to say not yet, and how to speak to a lender with steady hands. Begin with a principle that keeps founders out of trouble. Revenue before rows of cells. If a spreadsheet says a big idea will be great someday, test the smallest cash signal you can earn this week. A deposit for a start date. A pre-order for a limited batch. An annual plan that includes a real perk. A maintenance plan that people renew because it actually saves them time. When a small signal appears, you build on it. When it does not, you adjust. This is bootstrapping in practice. It is not romantic austerity. It is the craft of turning tiny yeses into a durable engine. Bootstrapping has 4 quiet tools that work across almost any business. The first tool is the deposit. A deposit books a date and books your helpers. It pays for materials or contractor hours before you spend your own money. It sends a message to the buyer and to your nervous system that this is real. The second tool is prepay. In services, the prepay is a deposit plus a clear plan for the balance on handoff. In subscriptions, the prepay is an annual plan that offers something true like 2 months free or priority support. Prepay improves cash, shortens payback, and buys time to improve the product. The third tool is phased scope. When a job is big, do it in steps with a small handoff and a small payment after each step. You get paid while you build. You also reduce risk because each step can course correct. The fourth tool is partner exchange. You trade value with a peer vendor where both sides win and no one writes a big check. Photos feed your launch page. Your launch page feeds the photographer. The value is written down so both sides keep the rhythm. Even when you bootstrap, well, there are moments when borrowing is smart. An asset that earns more than it costs and pays you back fast. Equipment that doubles throughput on days when demand is proven. Inventory for a seasonal spike when pre-orders and deposits already cover most of the outlay. A small short bridge between invoicing and payment when work is complete and your time to cash is fixed on the calendar. The rule is simple. Debt is a tool to match timing, not a trick to hide losses. If a loan helps cash line up with the cash you already know how to create, the risk is sensible. If a loan asks cash from a future you cannot describe, you are betting with rent money. To borrow wisely, you need one number in your mouth. The coverage ratio. It is the cushion between the cash the business will produce and the cash the loan requires you to pay each month. People call it many things. Think of it as a simple statement. Each month our cash from operations is this many times larger than the loan payment. When the ratio is 1, the payment matches the available cash and there is no room to breathe. When the ratio is 1.25 or more, there is room for a small wobble. When the ratio is 2, you sleep. You can do the math on paper. Take your conservative monthly contribution after variable costs and after the base expenses you cannot avoid. Divide that by the proposed monthly payment. Run the same number with a gentle stress, perhaps 20% lower contribution than usual, and see if you still breathe. If the ratio is thin at the stress level, do not sign. You do not need a banker to tell you the truth. Your own numbers will whisper it. Loans come with shapes that matter. A fixed rate keeps your payment steady. A variable rate can move on you when the economy shifts. Fixed terms are easier on a small team. A straight loan has a set payment that blends interest and principal each month. A line of credit is more flexible but demands self-control. You draw only what you need and you repay quickly when cash returns. Invoice factoring advances cash against a bill you have already earned. It is expensive cash and should be used like a life vest, not like a wardrobe. Credit cards are fast and forgiving for small buys, and they can destroy your month if you pretend that the statement is not a loan. Always choose the cheapest cash that fits the actual job and the actual time frame. Always write the plan to repay in the same sentence as the plan to draw. Lenders also come with personalities. A local bank likes steady rhythm and clean statements. A credit union is often gentler and more community-minded. A fintech lender is fast and asks less at the front. The speed costs you in rate and in fees. A supplier can be a lender when they agree to net 7 or net 14 and you set up auto-pay. A landlord can be a lender when they accept a lower base and a small share when the month is strong. The person across the table matters as much as the paper. Choose partners who understand that you intend to stay and serve. Offer predictability. Ask for terms that match your cash reality. Speak in plain words. If someone tries to rush you with urgency you did not bring to the room, walk away. Borrowing is also paperwork. You will see words you can learn to hear without fear. A covenant is a promise you make beyond paying each month. Keep it simple if you can. A personal guarantee means your own assets stand behind the loan if the business fails. Sign this only when you can repay from salary somewhere else if everything goes wrong, or when the amount is small and the use is a sure match to cash. A lien is a claim on equipment or on accounts if you do not pay. Do not stack liens from many places. It creates a snarl when something small goes wrong. A prepayment penalty means paying early costs money. Avoid it when you plan to pay fast. None of these words are curses. They are levers and locks. You can say yes to some and no to others. When in doubt, shrink the request until the paper becomes clean. Now let us return to our 3 running stories and watch borrowing and bootstrapping side by side. The print stand works weekends and holidays on a lively street. Most demand is medium-sized prints. The single press runs non-stop for 2 hours on bright Saturdays and align forms. The owner runs numbers with a pen. Each medium print contributes $17. A second press would allow 12 more prints on each busy day. There are 8 busy days this month. 12 times 8 times 17 is $1,634 of added contribution. A small used press costs $800 and there is a possibility to buy it with a 3-month plan from the supplier at 0 interest if paid on time. The coverage is strong even under a rainy weekend scenario. This is smart debt. The owner signs a simple purchase plan with auto pay for 3 even payments. The stand posts a small clip of 2 presses humming and a happy line moving quickly. The loop feeds the cash. The debt disappears in a season. The owner declines a second offer for a costly lighted sign that promises attention but cannot be tied to a specific cash return. This is the difference between borrowing to widen a proven pipe and borrowing to throw glitter at a guess. The 1-page studio has steady demand. 5 to 8 pages a month is now normal. The founder wants to improve speed by subcontracting a standardized portion to a reliable partner. The partner charges $100 per page. Variable cost climbs and contribution per page drops by $100. Throughput doubles. The founder does not borrow. The work is funded by deposits. Cash in leads cash out by 2 days because the partner invoices weekly. The studio matches payments to Friday bank clears. Small prepay, phased scope, and a dependable calendar are enough to expand. In month 3, a local micro-grant appears for digital jobs. The founder applies with a clear plan and uses half the grant to build a library of templates and half to create short help videos. These assets keep working long after the grant is spent. The studio stays free from loans because bootstrapping and small grants already fit the system. The clinic booking tool faces a different question. Hosting and email prices are stable. The churn curve is gentle. A basic analytics module would help clinics spot idle hours and set better appointment blocks. Building it will take 6 weeks of serious coding. The founder considers a small loan to hire a contractor so that the feature arrives before winter peak. The math is honest. 2 clinics agree to an annual prepay at a small discount if the module arrives by the end of next month. That is $600 of cash up front that would otherwise trickle in monthly. The contractor will cost $1,200. The founder can cover half from cash and half from a 6-month line of credit that only draws when invoices arrive. The coverage ratio is comfortable even in a slow month. The founder signs for a small line, draws $200 at a time during build weeks, and repays each draw with the next 2 annual plans. This is borrowing against demand the founder can now describe in exact sentences. It is not pretending that a miracle will save a vague idea. Debt can also hide inside vendors when you do not name it. If you buy inventory in a big batch because the price is slightly lower but the items will sit for months, you have loaned your cash to your shelf with no interest. If you pay a contractor a large retainer because it feels generous and then struggle to use the hours, you have given a zero-interest loan in the wrong direction. Smart debt discipline applies to your decisions even when there is no bank. Buy small and often until flow is certain. Pay for work after handoffs, not in hope. Ask vendors for terms when rhythm is proven. Offer your own customer subscriptions when it truly serves both sides. When you sit down with a lender, you do not sell a dream. You tell a clear story the way you would tell it to a friend. Our customers buy this promise at this price with this timeline. Our variable costs are these, and our base per month is that. Each unit contributes this much. We sell about this many units in a conservative month. We want to borrow this amount to do this specific thing, and the monthly payment will be covered this many times over by our cash even if revenue dips by a fifth for a month. We will also keep this minimum in our account as a cushion. We will pay by auto draft on this day, which matches our cash in rhythm. Here is the list of invoices or pre-orders or signed contracts that support the timing. This is not grand theatre. It is a calm sequence. People who lend like this sound because it respects reality. There are cases where saying no to a loan is a sign of health. If you plan to borrow to fund marketing because acquisition cost is high and you hope scale will fix it, pause. Advertising never fixes broken unit economics. First, lower your CAC with better channels and better proof. If you plan to borrow to make payroll because your scope creeps and refunds rise, pause. Fix scope and time to first win. If you plan to borrow because a new idea feels exciting and you cannot find a buyer who will place a deposit, pause. The buyer is telling you the truth the math wants you to hear. Creditworthiness grows like any other loop. You begin small. You deliver to the penny. You keep statements clean. You set auto pay for everything you can. You retain a minimum balance rule and follow it like a ritual. You build a record your future lender can glance at and smile. In a year, the same bank that gave you a modest line will renew it at a lower rate and a higher ceiling because you behaved like a grown business. The rate is not an opinion about your worth as a person. It is a price for the risk the lender believes they see. Your job is to make the risk look boring because you are boring in all the ways that matter. Risk also shrinks when you write your own rules and put them on the wall. Borrow only for assets or activities that have a clear path to cash in the same season. Keep the coverage ratio above 1.25 even under a worry scenario. Prefer fixed rates and payments you can set by calendar next to your own cash in days. Avoid personal guarantees unless the amount is small and the plan is strong enough to repay from outside income if the worst happens. Pay earlier than required when months are strong unless the paper penalizes you for kindness. If you accept a penalty for early payoff because the rate was low, plan to keep the schedule and use spare cash to widen your cushion instead. These are not commandments. They are habits that leave you free to focus on your craft. Let us finish with 7 scenes you can hear as you walk. You look at your checking balance on Monday morning. You breathe and speak a sentence. Our base this month is covered by the first 5 projects. We have 4 in the calendar and 2 in final chat. We will move 1 to a deposit today. You message a past client with a refresh idea they have already asked about. The yes comes. That was bootstrapping. A supplier offers a bulk price if you buy 3 months of blanks. You do not. You ask for a smaller price cut and a weekly delivery so your cash sits in your account, not on your shelf. The supplier agrees because weekly auto pay is worth more to them than a small discount. That was smart debt without paper. Your lines at the stand grow again. You price a second press with honest math. You ask the supplier for a pay in 3 plan. You project a rainy weekend and the numbers still work. You sign. You post a small clip and the extra capacity pays the note before it is due. That was debt as a timing tool. A friend suggests a loan to spend on ads because growth feels slow. You check your CAC and time to yes. The problem is not awareness. It is your offer page and reply speed. You rewrite the 10-second line, move best first on the price ladder, and set alarms to reply within an hour. Leads start saying yes without a loan. That was restraint. A bank manager asks for a personal guarantee on a line larger than you need. You decline politely and ask for a smaller line at the same rate with a fixed auto pay and no personal guarantee. You get it. You use half, repay it in 3 months, and ask for a renewal at the same size. That was dignity plus patience. A clinic cancels in month 1 and says they never saw the first win. You thank them, close the account, and then change onboarding so the first booking arrives on day 1 with guidance. Churn drops. LTV rises. You do not patch it with discounts or chase new sign-ups with borrowed ad dollars. You fix the pipe. That was unit economics before urgency. A city program offers a small grant for storefront improvements. You could buy a shiny sign. You choose a simple canopy that keeps printers dry and lets you serve on rainy afternoons. The grant funds cash that returns cash. That was design. Bootstrapping and smart debt are not 2 separate religions. They are tools that share a goal. Keep your oxygen steady. Borrow to match timing on cash you can already describe in sentences. Refuse to borrow to hide problems that sentences cannot clean. Most of your growth will come from small offers sold on time and delivered well. When a loan can multiply that rhythm safely, take it with a calm hand. When it cannot, keep walking and let your buyers fund the next step. In the next chapter we will look beyond money raised and money borrowed and focus on money asked for and given by institutions that expect neither ownership nor strict repayment. We will explore grants, sponsorships, and pre-orders. You will learn how to write a simple proposal in the voice of outcomes, how to avoid the traps of free money that is not truly free, and how to use early revenue from pre-orders without breaking trust.